Please like, share, and subscribe. Wishing you happiness and good luck every day.
All right, let's dive in. Today, we're talking about the biggest financial market in the world, the foreign exchange, or as you probably know it, Forex. So whether you're just a little curious or you're actually thinking about trading, we're going to break down all the absolute essentials for you right here. So just to give you a sense of the sheer scale we're dealing with, take a look at this number. That's $4 trillion. And get this, that's not the total value of the market. Nope, that is how much currency gets traded every single day. I mean, it completely dwarfs the stock markets. It is by far the largest financial playground on the entire planet. But, and this is a huge but, with a market that massive, you have to understand that the potential for huge profit is matched by the potential for some really significant risk. This is the standard warning you're going to see everywhere, and believe me, it's there for a very good reason. Honestly, understanding and respecting this risk is the first and probably the most important step for any new trader. Okay, so with that crucial warning out of the way, let's start peeling back the layers and really get to the bottom of what Forex trading is all about. At its core, it's actually pretty simple. The Forex market is just the global stage where all the world's currencies are exchanged. You've got huge companies using it for international trade, banks are using it for massive transfers, and of course, traders are using it to speculate. So for a trader, the main goal is to make a profit from the way currency values are constantly changing. Think about it like this. Let's say you exchange your money for euros for a trip to Paris. While you're over there, the euro gets stronger compared to your home currency. When you get back and change your leftover euros, you actually get more money back than you started with. Well, Forex trading is that exact same idea, but you're doing it on purpose, online, and the whole point is to try and make a profit. Okay, so now let's go behind the scenes a little bit and see how this massive global market is actually put together and find out who the real key players are. Now, here's what's really fascinating and what makes Forex so different from, say, stocks. Stock markets are centralized, like the New York Stock Exchange. There's one central place. But Forex, it's completely decentralized. There's no single building or location. Instead, it's this huge network of banks and institutions, and they're all competing with each other, which is actually great for you because it helps make sure the prices are competitive. And this competition all happens within a pretty clear hierarchy. At the very top, you've got the interbank market. This is where the world's biggest banks trade massive amounts of currency directly with each other. Just below them, you have other institutions and hedge funds. And then way down at the bottom, yep, that's us, the retail traders. We get access to the market through brokers who are connected all the way up this chain. So now that we know the structure, let's get into the nitty-gritty of how a trade actually works. And it all revolves around one single central concept, the currency pair. This is so important. In Forex, you never just buy the US dollar or the euro. You are always exchanging one currency for another. That means every single trade involves two currencies at the same time, one that you're buying and one that you're using to pay for it. And that's your currency pair. And this image shows you exactly how to read one. So in the pair EUR/USD, the first currency, the euro, is called the base. The second one, the US dollar, is the quote. Now, that price, that tells you how many units of the quote currency it costs to buy just one single unit of the base currency. So in this example, 1 euro costs 1.4745 US dollars. Simple as that. So here's the bottom line. Your entire trading decision boils down to a really simple prediction about that base currency. If you think the euro is going to get stronger against the dollar, you buy the EUR/USD pair. If you think the euro is about to get weaker, you sell the pair. It is literally that direct. Okay, that's all the theory, but how does the beginner actually step into this market? Let's talk about some practical and cautious advice for getting started the right way. So, the market is open 24 hours a day, 5 days a week, but not all hours are created equal, not by a long shot. The most activity, the most volume, and often the best trading opportunities happen when these major markets overlap. For instance, that window between 1 p.m. and 5 p.m. GMT, when both London and New York are humming along, that's a classic high-volume, high-action period. And, just as important as knowing when to trade is knowing when not to. As a beginner, you really want to be careful on Mondays, when the market is kind of digesting all the weekend news, and also on Fridays, when the volume tends to dry up. And trading around a major news release, whoa, that creates a ton of volatility, and it's really a game best left to the seasoned pros. Your broker is your gateway to the entire market, so picking the right one is absolutely critical. First, look for one that's accredited by a national regulator. Super important. Make sure they offer a free demo account so you can practice without risking real money. Check for tight spreads. That's just the small difference between the buying and selling price, and it's basically your cost for making a trade. The tighter, the better for you. And of course, do your homework. Read online reviews and really read their terms and conditions.
At a final, really serious point on this, the incredible ease of online trading has unfortunately also opened the door for a lot of scams and rogue brokers. So please be vigilant. Do your research. A little bit of prevention here is worth a whole lot of cure. At the end of the day, there's no magic button. There's no guaranteed secret strategy. Any book or website that promises you that is just selling a fantasy. The single best tool you will ever have, the one thing that truly maximizes your chances for success and minimizes your losses, is market knowledge. It all comes down to education, period. So we've covered the what, the how, and the who of Forex trading. You have the fundamental building blocks now. And that brings us to our final thought. Given the high risks we've talked about, the real question for any beginner isn't just how to trade, it's about taking a serious moment to decide if you should.
Welcome to The Explainer. Have you ever been curious about Forex trading but just had no idea where to even begin? Well, you're in exactly the right place. Today, we're going to lay out a simple, clear roadmap to help you get started. Okay, before we jump into the potential of Forex, we have to start with a crucial reality check. Seriously, this isn't the fine print you just scroll past. This is the absolute foundation of responsible trading. Understanding and, more importantly, respecting this warning is your first real step.
And that's really the key, isn't it? This warning isn't meant to be a stop sign. Think of it more like a guidepost. It's what separates pure gambling from smart, strategic trading. Your education, your whole journey, really starts right here. So with that essential caution front and center, let's explore the fundamental balance of Forex. We're calling it promise and peril. What does success in this world actually look like? And how do you weigh those potential rewards against the very real risks we just talked about?
Let's just bust a huge myth right out of the gate. Success in trading is not about having a perfect record. Not at all. I mean, even the top professionals have losing trades. Success is all about making sure that, over the long haul, your wins are big enough to more than cover your losses. It's a marathon, for sure, not a sprint.
So to even begin to build a winning strategy, you've got to understand the sheer scale of the playground you're in. Let's zoom out for a second and take a look at the world's biggest market.
When you boil it all down, what is Forex? It's simply the global market where you exchange one country's currency for another. You can think of it like you're placing a bet on the economic health of one country against another, and you're trying to profit as their values shift.
And to put the size of this market into perspective, just look at this number. $4 trillion. That is the amount of money traded every single day. It absolutely dwarfs all the world's stock markets combined. It's not even close.
Now, one of the most interesting things about Forex is its structure. You see, unlike a stock market that has a central hub, like the New York Stock Exchange, Forex is decentralized. This means prices are coming from tons of different institutions all competing with each other. And for you, the trader, all that competition, it usually means you get better, tighter prices. So we know where the trading happens. Now let's get into the nuts and bolts of how it happens. We're going to do that by decoding the most fundamental piece of every single Forex transaction, the currency pair. There's a reason it's called a pair, right? You can't just buy euros by themselves. You have to buy euros with something else, like, say, US dollars. So every single trade you make is you buying one currency and selling another one at the exact same time.
Let's break down how to actually read one of these pairs. So in this example, UR/USD, that first currency, the euro, is called the base. Just think of it as the thing you're actually buying or selling. The second currency, the US dollar, is the quote. That's the price. So this quote tells you how many US dollars it costs to buy just 1 euro. So how do you make a profit? It really comes down to a simple 3-step process. First, you form a belief. You think the base currency, the euro in our example, is going to go up in value. Second, you act on that belief and you buy the pair. And third, if you were right and the value does go up, you sell the pair, close the trade, and lock in your profit. Okay, so you know how a trade works.
The next logical question has to be, when should you trade? The Forex market is famously open 24 hours a day, but honestly, that can be a little misleading. Not all hours are created equal, and for a beginner, timing can be absolutely everything. The reason the market is open around the clock is because it literally follows the sun around the globe. It's like a relay race. As the markets in Asia are winding down, Europe is just opening up. And right as Europe is closing for the day, New York is getting into full swing. It's this continuous cycle that keeps the market moving. Now, here is a major pro tip, especially for beginners. The absolute best times to trade are often when these big market sessions overlap. That window when both London and New York are open, for example, is usually the busiest, most active part of the day. And for a trader, more activity often means more opportunities and better prices. And on the flip side, there are definitely times when you want to be extra careful. Early Monday mornings can be super unpredictable, and Friday afternoons tend to slow way down. And unless you're a seasoned pro, you probably want to stay on the sidelines during major news events. The market can get incredibly wild, and it's just not worth the risk when you're starting out. All right, we've covered the what, the how, and the when. We are now on the final leg of our roadmap, the practical part. How do you actually take your first steps and open up a trading account? Your journey really kicks off with two super important decisions. First, you've got to choose your guide. That's going to be your broker. And second, you need to pick your vehicle, and that's your account type. Choosing a broker is a massive decision, so don't rush it. The very first thing you need to check, and this is non-negotiable, is if they're regulated by a major financial authority. After that, do your homework. Compare their fees, read reviews from other traders, and most importantly, find one that offers a free demo account. Practicing with zero risk is the single best thing you can do before putting any real money on the line. So once you've found a broker you trust, you'll need to pick an account type. And this choice really comes down to your personal comfort level with risk and, of course, how much capital you're planning to start with. So this table breaks down your three mini options. They're based on something called lot size, which is just a fancy term for the standard amount of currency you're trading. A standard lot is $100,000, which is definitely for experienced traders. For anyone just starting out, the clear choice is either a micro or a mini account. They let you trade in much smaller chunks, which means you can learn the ropes with way less risk. And there you have it, a clear beginner's roadmap to get you started in Forex. You now have a solid foundation. You know what the market is, how a trade works, and you've got a plan for getting started safely. The Mac is officially in your hands. So the real question isn't just if you're ready to begin. It's, are you ready to commit to the discipline that this journey is going to require?
You know, the world of Forex trading, it really has its own language, doesn't it? And if you're not in on it, it can feel like you're on the outside looking in, trying to crack some kind of secret code. Well, today, we're going to hand you the key.
Have you ever just looked at a trading screen? All those numbers, those acronyms, it's like trying to read an alien language, right? Well, you're definitely not alone. The market has its own lingo, for sure. But trust me, it's something you can absolutely pick up.
So that's exactly what we're here to do. Yeah, think of us as your personal translator for all this. We're going to break down the essentials so you can not only follow the conversation, but actually start speaking the language of the market yourself.
Okay, so here's the game plan. First, we'll cover the basic language itself. Then, we'll look at how market moves are measured. After that, we'll get into the really powerful stuff, how to amplify your trades, then how you actually place an order. And finally, we'll wrap it all up with a super practical checklist you can use.
First things first, you've got to learn the alphabet before you can read the book, right? One of the sources for this explainer put it perfectly. An understanding of this specialist terminology is a vital starting point for any trader. So let's build that foundation together right now.
So how do we actually measure movement in the Forex market? It's not in dollars and cents like you might think. Traders have their own special unit of measurement, and it's called a pip. Just think of it as the smallest, most fundamental building block for tracking every single price change.
So what exactly is a pip? Well, it's basically the smallest possible change in price for a currency pair. For instance, if a pair moves from 1.0735 to 1.0736, that's a 1 pip move. I know, that sounds incredibly tiny, right? But believe me, as we're about to see, these little pips, they're the name of the game.
And what's really cool about this is that it shows you exactly where to look. See, for most of the major currency pairs, that fourth number after the decimal point, that's the pip. That's the pulse of the market you're going to be watching.
Now that we can measure the market in pips, the big question is, how do traders make those tiny little movements actually mean something? And that, my friends, is where these three huge concepts come in: leverage, lots, and margin. Let's break them down.
Okay, first up is leverage. You can kind of think of this as the great equalizer for a regular retail trader. Basically, it's like a tool, or a loan if you will, from your broker that lets you control a huge amount of currency with just a small amount of your own money. And what that does is it magnifies those tiny pip movements into potentially significant profits.
And this slide just illustrates it perfectly. Look at this. With a leverage of 100 to 1, your own $1,000 suddenly gives you the trading power of $100,000 in the market. I mean, that's a total game changer.
Okay, but, and this is a huge but, we have to talk about the warning. Leverage is, without a doubt, a double-edged sword, because while it can absolutely magnify your wins, it will magnify your losses just as fast and just as powerfully. This is a risk that you absolutely have to understand and respect before you even think about placing a trade.
All right, next up, lots. See, you don't just trade random amounts of cash. Trades are actually grouped into standard sizes, and we call them lots. So as you can see here, a standard lot is 100,000 units of currency. But what's really cool is that brokers also offer smaller sizes, like mini, micro, and even nano lots. This is fantastic for traders who are just starting out or want to have more precise control over their risk.
So if leverage is the loan from the broker, think of margin as your down payment. And it's not a fee. You don't lose this money. It's more like a good faith deposit. It's the bit of your own cash that the broker holds onto just to open your leverage trade and, to cover any potential losses.
Okay, and this slide just puts it all together so simply. Step 1, you pick your trade size, your lot. Let's say a standard lot, which is 100 grand. Step 2, you put up the required margin. So with 100 to 1 leverage, that's just $1,000. And boom, step 3, you are now controlling that full $100,000 position. All right, so we've got the concept, we've got the tools, but how do you actually make a trade happen? Well, you do it by placing what's called an order. And an order is really just a specific set of instructions you give to your broker.
When you really boil it down, every single trade is based on one of two simple beliefs. If you think a currency is going to go up in value, you go long, meaning you buy it, hoping to sell it later for more. And if you think its value is going to go down, you go short. You sell it, planning to buy it back later for less. Simple as that.
So, the most direct way to jump into a trade? That's with a market order. This is basically your get me in right now button. You'd use this when speed is what matters most, and you just want to get your trade executed immediately at whatever the best price is at that very second.
Now, if you want to be a bit more strategic about your entry point, you'd use a limit order. This lets you tell your broker the exact price you are willing to buy or sell at. It's all about being patient, right? You're waiting for the market to come to your price instead of you chasing the market.
And now we come to what is arguably the most important order of them all, the stop loss. This is your automated safety net, your eject button. It's a preset instruction that automatically closes your trade if the market moves against you by a certain amount. Honestly, it's not just a tool, it's an essential piece of discipline that protects your money.
And get this, there's an even smarter version called a trailing stop. Just look at how this works. As your trade starts making you money, the stop loss automatically moves up with it, locking in your profits as you go. But here's the magic. If the price suddenly turns around, the stop stays right where it is, protecting the gains you've already made. It's a really dynamic way to let your winning trades run while still managing your risk.
Wow. Okay, we have covered a lot of ground, right? From the tiniest little pip to these super powerful orders. So before you ever click that buy or sell button, it is so important to have a clear process. This checklist brings everything we've talked about together. Think of this as your pre-flight checklist for every single trade. Have you picked your currency pair? Have you decided if you're going long or short? And is that based on solid analysis? And this is the big one. Have you already figured out your exit points, both for taking profit and for cutting your losses, before you even get in? Following a structured plan like this, that's how you trade with discipline, not with emotion. And this final thought from one of our sources really brings it all home. See, trading isn't about being right 100% of the time. Nobody is. It's about having a strategy and having the discipline to actually stick to it. It's really about managing your losses, keeping them small, so that over the long run, your winning trades can take care of themselves.
So there you have it. Pips, leverage, lots, orders, The whole shebang. The essential vocabulary of the Forex market. The language isn't a secret anymore. You've got the fundamental tools now. The real question is, what are you going to build with them? What's your trading story going to be?
All right, let's talk about the Forex market. Ever feel like you're just drowning in data, staring at charts and news feeds, trying to make sense of all that chaos? Well, you're in exactly the right spot. We're going to cut through all that noise and give you a real, practical guide to analyzing it like a pro. So, let's dive right in.
Seriously, you open up a currency chart or you look at a news feed and bam, it's just this huge wave of information overload, right? You are not alone in feeling that. It's a constant, relentless stream of data, and honestly, it can feel totally overwhelming. So the big question is, where do you even start? How do you navigate all that? So here's the secret. Success in trading? It's not about having a crystal ball or just getting lucky. It's really about learning to listen to what the market is telling you. Real success comes from having the right set of tools. Tools that let you translate all that market noise into a clear signal you can actually use.
Think about it. Without some kind of framework, all that data is just static on the radio. Price movements, news alerts, those big economic reports, it's all completely meaningless until you have a way to interpret it. The whole point here is to turn that raw, messy information into something you can actually act on.
And that brings us to your essential toolkit. Okay, there are three main methods every single trader uses. We've got fundamental analysis, technical analysis, and market sentiment. You can think of them as three different lenses you can look through. Each one gives you a totally unique and totally vital perspective on the market. And trust me, trying to trade with just one of these, it's a recipe for disaster.
Okay, let's start with our first tool, fundamental analysis. This one is all about understanding the big picture story. I want you to think of it like being a detective. Your job is to uncover why a currency might be moving, and the clues are all in the economic health of its home country.
So what that really means is you're using economic news and data, real-world events, to figure out how they're going to affect currency prices. You're basically looking under the hood at the economic engine to predict which way the car is going to go.
And the logic behind this is actually pretty simple when you break it down. A country with a strong, growing economy, well, it should have a strong currency, right? And if that economy starts to struggle, you'd expect its currency to get weaker. It's all about that direct link between economic health and the value of a currency. So what are the vital signs we're checking for? Well, here are the big ones. You've got stuff like employment rates, what the central banks are doing with interest rates, and of course, GDP. Those are massive. But you're also watching how people are spending with retail sales figures and what the country's trade balance looks like. These aren't just random numbers on a page. They're literally the heartbeat of an economy.
Okay, now this is a really important point, and it's something that trips up a ton of new traders. The market doesn't just react to the news itself. It reacts to surprises. See, what the analysts expect to happen, that's usually already priced in. It's the difference between what everyone was expecting and what actually happened that causes the big market moves. All right, so if fundamental analysis tells us the why, our second tool, technical analysis, is all about figuring out the when. This approach is totally different. It cares a lot less about economic news and focuses 100% on what the price itself is doing on the charts.
And this lays out the difference perfectly. You've got fundamental, which looks at news and the economy to figure out the why. And then you have technical, which looks at charts and patterns to figure out the when. They're not fighting each other. They're just answering different but equally important questions. Seriously, trying to trade while ignoring one of them is like trying to build a puzzle with half the pieces gone.
You know that old saying, history doesn't repeat itself, but it often rhymes? Well, that's the core idea here. Technical analysts believe that by studying what the price has done in the past, right there on the chart, they can spot patterns and trends that give them some really powerful clues about where the price might be headed next.
So what this really does is bring a sense of order to what looks like pure chaos. It takes that jagged, random-looking price chart and helps you see the patterns hidden inside, the trends, these support levels, which you can think of as a price floor, and the resistance levels, which act like a price ceiling. It's all about finding that clear signal inside all the noise. But wait a second, an economy and a chart, that's not the whole story, is it? What about the people who are actually doing all the buying and selling? That brings us to our third and final tool, and this one adds that fascinating human element. It's called market sentiment, and it's basically about reading the room. It's all about understanding the collective psychology of the crowd. Because at the end of the day, what drives markets? People. And people make decisions based on two really powerful emotions, fear and greed. So this tool is all about gauging the overall mood. Are traders feeling optimistic and buying everything up, or are they pessimistic and selling off? It's like taking the emotional temperature of the entire market.
And the classic way we talk about this mood is bulls versus bears, right? When the market is bullish, everyone's optimistic. Buyers are in control, and prices are charging upwards like a bull. But when it's bearish, pessimism sets in. The sellers take over, and prices start to drop. Figuring out which animal is running the show is absolutely crucial.
Okay, so now we have our three tools. We have the why from fundamentals, the when from technicals, and the who from sentiment. But you know, a master craftsman doesn't just have tools in a box. They know how to use them all together. And that's what this is all about, combining them into one powerful, cohesive strategy.
This quote right here really nails it. The most successful traders, they almost never rely on just one of these methods. And why is that? Because using just one tool in isolation is basically just guessing. The real power comes when you use them to confirm each other. It helps you build a much stronger, much more solid case for any trade you're thinking about making.
So here's a really simple but powerful way to put this all into practice. First, you might use your technicals to spot a potential trend on the chart. That's your win. Next, you confirm that trend with your fundamentals. Is there a real economic story backing this up? That's your why. And finally, you gauge the momentum with market sentiment. Is the rest of the market on your side, or are you swimming against the current? That's your who.
And this is the real payoff. When all three of your tools are pointing in the same direction, man, your confidence in that trade just skyrockets. Look, this isn't about being right every single time. Nobody is. It's about building a solid, logical case for your decisions and massively reducing the chances of getting blindsided by something you just didn't see coming. So there you have it. We've just unpacked the three essential tools you need to analyze the Forex market. This is the framework that helps you turn all that chaos into clarity. The only question left is, now that you have the toolkit, what are you going to build with it?
Hey, have you ever looked at one of those financial charts and just your eyes glaze over? It's like a secret code, right? All those lines, colors, crazy shapes. Well, guess what? Today, we're going to crack that code together.
Yeah, that jumble of lines and bars, it can seriously feel like it was made just for Wall Street pros, right? But you're not alone in feeling that way, not at all. The truth? It's just a language. And like any language, you can absolutely learn to read it.
And that's our mission for the next few minutes. Seriously, by the time we're done here, you're going to have the skills to look at a chart and actually see the story it's telling, that epic battle between the buyers and the sellers.
All right, let's jump right in. The best way to think about this is like learning a new language. We're not going to start with, complex poetry. Nope. We're starting with the ABCs and building our way up from there.
So in this market language, there are really three main ways people write it. Three main chart types. These are our building blocks. The super simple line chart, the more detailed bar chart, and the one you've probably seen everywhere, the candlestick chart.
Okay, first up, the line chart. Let's call this the alphabet. It's the absolute simplest, most basic way to see what's happening. It's the foundation for everything else we're going to talk about.
And it's pretty much what it sounds like, right? It's just a single, clean line. All it does is connect the closing price from one day to the next to the next. It cuts out all the noise and just gives you a smooth look at the overall trend.
So here's the key takeaway for line charts. Yeah, it hides all the crazy ups and downs during the day, but that's its strength. It is perfect for getting that quick, big picture view. Is the trend up, down, sideways? The line chart shows you in a split second.
Okay, so we've got our alphabet down. Now let's start making some words. That's where the bar chart comes in. Each little bar packs way more information. This is the next level up on our way to fluency.
And the bar chart introduces us to a super important concept. You're going to hear this a lot, OHLC. It stands for open, high, low, and close. Every single bar gives you those four key pieces of intel for a period of time. This is where things start getting really interesting.
So let's take one of these bars apart and see how it works. The very top of that vertical line, that's the highest price hit during that session. The very bottom, you guessed it, the lowest price. Now, see that little horizontal tick on the left? That's your opening price. And the one on the right? That's the close. Boom, 4 pieces of data in one simple little symbol. Not so secret anymore, is it?
All right, we've learned the words. Now it's time for the poetry.
let's talk about candlestick charts. Now get this, they show the exact same OLC information as a bar chart, but they do it in this incredibly visual, intuitive, honestly, kind of beautiful way. This is where the story of the market really comes alive.
So each candlestick has two main parts. You've got the thick part, that's called the body, and then you have these thin lines sticking out the top and bottom, which are called shadows or wicks. The very tip of the top shadow is the high price, and the bottom tip of the lower shadow is the low. The body, well, that tells us the story of the open and the close.
And this is the magic of candlesticks. The color of that body tells you a story in an instant. If the body is green, or sometimes white, that's bullish. It means the price closed higher than it opened. If it's red, or sometimes black, it's bearish. The price closed lower. It's a super fast visual cue for who won that round, the buyers or the sellers. Okay, so we know what the parts are called. Now let's learn to read the stories they tell, because the size and the shape of that body and those shadows, they are packed with clues about what the market is feeling. It's like watching that battle between buyers and sellers play out in real time.
First, just look at the body. Is it long? A long body screams a decisive victory. Either the buyers or the sellers were totally in charge. But a short, stubby little body? That tells you there wasn't much of a fight at all. The price didn't really go anywhere. It's a sign of a pause, or maybe indecision.
Now for the shadows, or wicks. These tell a story of rejection. Think about it. A long shadow sticking out the top means buyers tried their best to push prices way up, but sellers slammed them back down. It's a failed rally. And the opposite is true for a long lower shadow. Sellers tried to dump the price, but buyers came roaring back. It's like seeing the high water mark of a battle. Okay, now check this one out. This is a really powerful candle. It's called a Mariposa. See how it has no shadows at all? No wicks. That means the price opened at the very low and closed at the very high, or the other way around. This is pure, absolute control. It's like a knockout punch by either the buyers or the sellers. And then you have the complete opposite of that knockout punch, the doji. With the doji, the open and close prices are basically the same, so there's almost no body at all. It's a perfect stalemate, a total tug-of-war where nobody won. When you see a doji, it often means a trend is running out of gas. The market's just thinking.
But here's the most important part. The real power isn't in reading just one single candle. It's about reading them together in a sequence. This is how we go from single words to building full sentences and understanding the market's real story.
For example, check out this pattern. It's got a great name, 3 Black Crows. What is it? It's just 3 long red candles in a row after the price has been going up. It's a pretty strong signal that the sellers are taking over, and the trend might be about to reverse. It's like seeing storm clouds gathering. And of course, there's an opposite. The 3 white soldiers. This time, it's 3 big green candles marching up after a period of falling prices. It's a really strong hint that the buyers are back in town and taking charge. It's like the cavalry arriving. So, if you remember just one thing from all this, let it be this. Context is everything. A single candlestick, it's just a data point, a letter. But when you see them together, forming a pattern as part of a bigger trend, that's when you're getting real, valuable information. And there you have it. In just the last few minutes, we've covered the fundamentals. You learned the alphabet with the line chart, you started forming words with the OHLC bar chart, and now you can read the rich poetry of candlesticks. You're not just staring at lines anymore, you're reading the story of the market. So, you now have the key. You can decode this language. The next step is all you. It's just about practice. So the question isn't, what on earth does this chart mean anymore? Now the question is, all right, what story is this chart trying to tell me? The market has secrets to share, and now you know how to listen. Have you ever stared at a financial chart and it just looked like a total mess? Just a chaotic jumble of lines? Well, what if I told you that mess is actually a language? Yep, and technical analysis is all about learning to read the story the market is telling us. So let's dive in and figure out how to decode it together. Okay, so if you're new to this, a chart like this one can look, well, pretty intimidating, right? It's just a bunch of jagged lines zipping up and down seemingly without any rhyme or reason. It's easy to feel like you're just staring at a wall of random noise.
But that's exactly why we're here. We're going to peel back that layer of chaos. The whole point is to learn how to spot the structure,
the patterns, the language that's hidden right inside all those price movements. It's all about finding order in what looks like, well, complete madness.
So, where do we even begin? We start with the single most important concept in all of technical analysis, the trend. Seriously, this is the foundation for everything, and I mean everything else.
You've probably heard this famous saying before, and trust me, it's famous for a reason. Before you do anything, you have to know which way the river is flowing. Is the market generally heading up? Is it heading down? Or is it just kind of going sideways? Answering that one simple question is the absolute first step.
So what exactly is a trending market? It's just a period where prices have a clear overall direction. Now look, it's not going to be a perfectly straight line. You'll see little dips and bumps against the main flow, but the general big picture movement is what we care about.
Basically, you can break down any market into one of three conditions. It's either in an upward trend, a downward trend, or it's what we call ranging, which is just a fancy way of saying it's stuck moving sideways with no real direction.
And what's driving all this? It's actually brilliantly simple. Good old supply and demand. When a market is trending up, it just means there are more people buying than selling, which pushes the price higher. And when it's trending down, you guessed it, more sellers than buyers, pushing the price lower. That's it. That's the engine behind every move you see.
And this leads to a really crucial piece of advice for anybody just starting out. If you can't spot a clear trend, sometimes the smartest move you can make is to just sit on your hands and do nothing. Seriously. Those choppy sideways markets are notorious for giving off confusing signals, and they can be incredibly tricky to trade.
So how do we actually use this? Well, we can visualize the trend by drawing a simple line. First, you just find two significant peaks or two significant valleys on your chart. Then connect them with a line. That gives you a potential trend. But the real magic, that happens on the third touch.
Because that third point of contact, that's your confirmation. When the price comes back, hits that line a third time, and then bounces off, that's when you can be much more confident that what you've drawn is legit. Why? Because it means a whole lot of other traders are seeing that exact same line and are reacting to it too.
All right, so now we know how to find the general direction. What's next? The next step is to figure out the boundaries that are holding the price in. We're going to go hunting for the market's floors and ceilings.
We call these concepts support and resistance. And honestly, the analogy is perfect. Just think of support as a floor that the price has a really hard time falling through. And resistance? That's a ceiling that the price struggles to break above. Simple as that.
And here's what that looks like in the wild. In an uptrend, you'll see the price go up and hit a peak. Boom, that's your resistance. Then it'll pull back to a little valley, and that becomes your support before it tries to climb higher again. These levels create a kind of channel for the price.
But why do these levels even exist? This is the really cool part. They aren't some kind of magic. They're all about human psychology on a massive scale. A resistance level is just a price point where a ton of traders collectively decide, okay, that's getting too expensive, and they start selling. A support level is where they all go, this looks like a good deal, and they start buying.
Because so many people agree on these price levels, they become these powerful signposts. They are zones where you can pretty much expect some action. The price is either going to bounce off and turn around, or it's going to smash right through it. So, if we know these signposts are so important, is there some way we can predict where they might show up before they happen? Well, yes, there is. And that brings us to a super popular tool that does exactly that.
That tool is called pivot points. Now, the best way to think of these is like an automatic calculator for support and resistance. They take the price data from the day before, the high, the low, and the close, and they spit out a whole set of potential support and resistance levels for today. It's an objective way to find those signposts we were just talking about.
Whoa, okay, I know this looks like a scary math test, but relax. You will never, ever have to calculate this stuff by hand. Your charting software does it all for you with one click. The only reason I'm showing you this is to prove a point. These lines aren't just drawn randomly based on somebody's gut feeling. They're 100% data-driven.
So when the price starts getting close to one of these calculated levels, traders are basically watching for two things to happen. Either it's going to bounce, where the price hits the level and reverses, or it's going to break through, where it pushes right through the level with some power, which usually means the trend is going to keep on going.
So how do traders actually use this in the real world? Oh, in all sorts of ways. Pivot points can literally form the backbone of a day trader's entire strategy. They can help you figure out the daily trend, they can point out good places to enter a trade, they give you logical targets for taking profits, and they even help you decide where to put your safety nets, your stop-loss orders.
Okay, let's bring this all home. We've just put together a simple but really powerful starter toolkit for reading pretty much any price chart out there.
So here it is, your new toolkit. It's got 3 key tools. Number 1, you use trend lines to find the overall direction. Number 2, you use support and resistance to map out the floors and ceilings. And number 3, you use pivot points to help predict where those key turning points might actually happen. See how they all build on each other? It's all about bringing clarity to the chart.
And let's wrap up with the single most important piece of advice I can give you. All these tools, they work best when you use them with the main trend, not against it. Especially when you're starting out, just remember, trying to fight the market's main direction is almost always a losing battle.
So that chart that looked like pure chaos at the beginning, hopefully it doesn't look so random anymore. Now you can start to see the story playing out. The story of buyers and sellers, of floors and ceilings, of collective psychology. The question isn't, what is all this noise anymore? The question is, now that you have the basic tools to listen, what story is the market trying to tell you?
All right, today we're going to decode the market's hidden language. We're diving into chart patterns, those specific shapes on a price chart that can give us clues about where the market might be heading next. So let's jump right in. So you look at a financial chart, and to most people, it just looks like this, right? A totally chaotic jumble of ups and downs, just a bunch of random noise with no rhyme or reason. But what if all that chaos is actually telling a story? What if it's not noise at all? What if it's actually a language, a visual story about the constant battle between buyers and sellers, happening every single second? Well, in this explainer, we're going to learn how to read that language together. See, that's the thing. Experienced traders, they don't see noise, they see patterns. And those patterns act like a kind of blueprint for their entire strategy. They see signals that hint at what's likely to happen next. At its heart, a chart pattern is really just a picture of the endless tug-of-war between the buyers, who we call the bulls, and the sellers, the bears. And if you can understand these pictures, you can start to spot potential signals to buy or sell. And that right there is why this all matters so much. As our source material points out, finding these patterns can signal a breakout is coming, and that's a big, sudden move in price, which can create some serious opportunities. The real trick is learning to spot them before they happen. Okay, so let's break this down. Pretty much all of these patterns fall into 2 big categories, and they give us 2 fundamental signals about where the price might be going. Think of a continuation pattern like the market just taking a quick breather before it keeps running in the same direction. But a reversal pattern, that's the signal that the party's over. The trend is probably about to turn around and head the other way. And here's a really interesting thing. A lot of these patterns show up during what we call market consolidation. This is when the price just moves sideways, kind of stuck in that tug-of-war. It's this moment of pure indecision, and it often happens right before a huge move. All right, first up, let's talk about the patterns that basically scream, warning, the trend is about to turn around. And this beast right here, this is the famous head and shoulders pattern. It's one of the most reliable reversal patterns out there. When you see this shape forming at the top of an uptrend, it's a huge sign that the upward push is running out of gas. So how does it form? It happens in 4 stages. First, you get a peak, that's the left shoulder. Then the price pushes even higher, that's the head. Then it tries one more time but can't quite make it. That's the right shoulder. You see, it's basically 3 failed attempts to go higher. When the price finally breaks below the neckline, that support level at the bottom, the reversal is on. Okay, theory is great, but here's what it looks like in the wild on a real chart. You can clearly see the left shoulder, the higher head, the right shoulder, and then boom, that decisive break below the neckline, followed by a strong move down. Now, here's a pro tip that comes straight from our source material. Keep an eye out for a big spike in trading volume right when the price breaks that neckline. That extra volume is like pouring fuel on the fire, and it gives you more confidence that the reversal is for real. A simpler version of that, but still super powerful, is the double top. Just think of it like the market hitting its head on a ceiling, falling back, trying again, and hitting its head on that same ceiling a second time. That second failure is often a huge sign that sellers are about to take over. All right, so that's what happens when a trend dies. But what about when it just hits the pause button? Well, those are called continuation patterns. So check this out. This is called a flag pattern. It forms after a huge sharp move up or down. That's the pole. Then the price kind of consolidates sideways in this little rectangular box, which looks like a flag. This is a classic sign the market is just catching its breath before continuing on its way. So what's going on inside the market's head here? It's actually pretty simple. After a big move, some traders start taking their profits. And at the same time, new traders are just waiting on the sidelines trying to figure out what to do. This creates a temporary stalemate before that original trend usually kicks back in.
Okay, now for a group of patterns that are all about indecision. These are the ones where the market just can't make up its mind, and the direction of the final breakout is absolutely everything.
Over on the left, you've got an ascending triangle. See how the buyers just keep hammering away at that flat resistance level, that ceiling, making higher and higher lows? This usually means the buyers are gaining strength, and an upward breakout is likely. The descending triangle on the right is the exact opposite, with sellers pushing against a flat floor, signaling they're gaining control.
And then you have the rectangle. This is where the price is literally just bouncing between a clear ceiling and a clear floor. It's a true deadlock. The only thing to do here is wait and see which way the price finally breaks.
Whew, okay, we have covered a lot of ground. Reversals, continuations, indecision. So let's pull it all together into a simple framework you can actually use. So here it is, your decoder ring. You can basically sort all these patterns into 3 buckets. First, you have your reversal patterns, like the head and shoulders, that signal a change is coming. Then you have continuation patterns, like flags, that suggest the trend is just taking a break. And finally, you have indecision patterns, like triangles, where you just gotta wait for the breakout to see who wins. But I gotta stress one really important thing here. None of this is a crystal ball. These patterns are a tool, not a guarantee. They help us understand the probabilities and see the story of what other traders are thinking. It's all about making more informed decisions, not predicting the future with 100% certainty. So, the next time you pull up a chart, don't just see a bunch of squiggly lines. Look for the patterns. Look for the stories of those failed attempts, those moments of indecision. You now have the basic tools to start reading the signs. So, what stories will the market tell you?
All right, let's talk about one of the most essential tools in any trader's toolkit, the moving average. Seriously, this thing's a game changer for cutting through all the market noise to see what's really going on. Let's get right into it.
You know that feeling, right? You pull up a price chart and it just looks like a total mess. All these spiky ups and downs, it's like pure chaos. Trying to guess which way the market is actually headed from this mess? Good luck. It can feel pretty impossible.
And this, right here, is why the moving average is so brilliant. Think of it like a noise-canceling headphone for your charts. It takes all that messy, chaotic price action, smooths it all out, and turns it into one clean, simple line. Suddenly, you get a much clearer view of the real trend. It literally turns noise into a signal.
So here's our game plan. First, we'll see exactly how these things tame all that chaos. Then, we'll dig into the 2 main types you need to know, simple versus exponential. After that, we'll learn how to actually read the trend lines, see why 2 averages are way better than 1, and finally, pinpoint trading signals using something called crossovers.
Okay, so let's start at the very beginning. How on earth does this tool take a chart that looks like a scribble and turn it into something so clean and useful? Well, the idea behind it is actually beautiful in its simplicity. A moving average just calculates the average closing price over a specific number of periods. And a period can be whatever you want, a day, an hour, even 5 minutes. So for a 10-day moving average, it adds up the closing prices of the last 10 days and divides by 10. That's 1 point on the line. Tomorrow, it drops the oldest day, adds the new one, and plots the next point. It keeps doing this, and that's what creates that smooth, flowing line on your chart.
Now, not all moving averages are built the same. There are 2 big ones you're going to hear about all the time, and you've got to know the difference. We're talking about the simple moving average, or SMA, and the exponential moving average, the EMA.
The simple moving average is, well, it's exactly what it sounds like. It's super simple. For a 10-period SMA, you literally just grab the last 10 closing prices, add them up, and divide by 10. Done. It's a no-frills, straightforward average that gives you that smoothed-out view.
And here's what that looks like in action. See those jagged black lines? That's the raw price. But that smooth blue line snaking through it, that's a 20-period SMA. Look at how it just completely ignores all the little, meaningless jiggles and shows you the big picture. In this case, a clear upward trend. So much easier to see, right?
So the SMA is awesome for getting that broad overview, but it does have one little weakness. Because it treats every single price point equally, it can be a little slow to react to what's happening right now. So what's the fix for that?
And that brings us to its more sophisticated cousin, the exponential moving average, or EMA. Here's the key difference. While the SMA treats all its data points the same, the EMA gives more importance, more mathematical weight to the most recent prices. So with the 10-day SMA, a weird price spike from 10 days ago has the same impact as yesterday's price. With an EMA, that old spike barely matters, but yesterday's price has a huge influence. This makes the EMA much faster and more responsive, which is why a lot of traders prefer it.
Okay, so we know what these things are and how they're different. Now for the really important part, how do we actually read them? What are they telling us about the market? On the most basic level, it's pretty intuitive. If you're in an upward trend, you'll generally see the moving average line pointing up and sitting below the actual price candles. And if you're in a downward trend, the line will be pointing down and riding above the price. It's kind of like a moving line of support or resistance.
But, and this is a big but, just using one moving average can get you into trouble. You might get a random price spike that crosses the line, making you think the trend is reversing, when really it was just a bit of short-term noise. It can give you a lot of false alarms.
So how do we fix that? Well, to get much more reliable signals and avoid all that confusion, most experienced traders don't use just one moving average. They use two. And this is where it starts to get really powerful.
See, using two averages is a total game changer. You'll typically use a fast one, like a 10-period, to track what's happening now, and a slow one, like a 50-period, to track the bigger underlying trend. The fast one tells you about recent excitement, while the slow one keeps you grounded in the long-term reality. In fact, some of the most watched averages in the entire market are the slow ones, like the 50-day and the 200-day. They're considered major indicators of a market's overall health. And the rule for reading them is just as elegant and simple. To confirm an upward trend, you want to see that faster moving average trading above the slower one. That tells you recent momentum is strong. And for a downward trend, you guessed it, the faster average will be below the slower one. It's a fantastic way to confirm what you're seeing.
Now, this relationship between the fast and the slow lines leads us to the grand finale, the most actionable part of this whole thing, spotting specific trading signals through what we call crossovers.
This is the moment traders are watching for. When that fast-moving average crosses up and over the slow-moving average, we call that a bullish crossover. It suggests that momentum is shifting to the upside, and it's often seen as a potential signal to buy. And on the flip side, when the fast average dives below the slow one, that's a bearish crossover, a sign that downside momentum is taking over and a potential signal to sell.
So there you have it. Moving averages take you from chaotic, confusing charts to identifying clear trends and even potential buy and sell signals. They let you tune out the static and focus on the real momentum. So the next time you pull up a chart, the real question is, what are you gonna see now that you couldn't see before?
Hey everyone, and welcome. Today, we're pulling back the curtain on some of the most essential tools in a trader's arsenal, indicators and oscillators. We're going to figure out how they actually work. You know, this is the million-dollar question, right? How in the world do you make an educated guess about where the market is headed next? Well, here's the secret. It's not about having some magical crystal ball. It's about having the right tools to read the story the market is telling you right now. So, to get you there, here's our game plan for today. We'll start with what these things even are. Then we'll look at the two main types, leading versus lagging. We'll peek inside the actual toolbox, cover the most important rule of all, and then wrap up by talking about how to build your own strategy. Okay, let's dive right in. What exactly are these trading indicators? What's their purpose? Think of them like a doctor's diagnostic tools. They take all that messy historical price data, all the ups and downs, and they run it through a formula to give you a much clearer picture of what's really going on. They help you spot a trend, figure out how much oomph is behind a price move, and maybe, just maybe, signal when it's time to make your move. Now, it's super important to know that not all indicators are created equal. They pretty much fall into two camps, and you gotta know the difference. The big question you have to ask yourself is this: are you trying to predict the future, or are you just trying to confirm what's happening right now? So on one side, you've got your leading indicators. These try to predict where the price is going to go before it happens. They give you these really early signals, which sounds great, right? But the catch is they can be wrong, a lot. On the other side, you have lagging indicators. These guys confirm a trend after it's already gotten started. They're way more reliable, but the trade-off is you might be a little late to the party.
All right, time for the fun part. Let's pop the hood and take a look at a few of the most powerful and popular tools in any trader's toolbox. We're going to break down 3 of the heavy hitters. First up, we've got Bollinger Bands. Really, their main job is to show you how volatile the market is. You know, is it going wild or is it pretty calm? And they do this by drawing 2 bands or lines above and below a central price line. And you can see exactly how it works right here. When the market gets choppy and uncertain, those bands get wider, they expand. But when things calm down, they tighten up. And what you'll notice is that the price tends to bounce around between these bands, almost like they're flexible walls on either side. Next up, the MACD. Now that's short for Moving Average Convergence Divergence. Don't worry, you don't have to remember that. It's one of the most popular indicators on the planet. Its goal is pretty simple: to measure the momentum or the speed of the price. Now take a look at the bottom of this chart. See that histogram with the bars? When those bars are above the middle 0 line and growing, it suggests that upward momentum is building. But when they dip below that line, it can signal that downward momentum is taking over. That switch from positive to negative is what can give traders clues about when to buy or sell. And finally, let's talk about the RSI, or the Relative Strength Index. The RSI is an oscillator, which is just a fancy way of saying it moves back and forth, kind of like a pendulum. And its main purpose is to help you spot when something might be overbought, meaning maybe its price has gone up too high too fast, or oversold, where its price might have dropped too low too fast. Here's the big idea. The RSI moves between 0 and 100. So if you get a reading up above 70 or 80, that's generally considered overbought territory. It's a warning that the trend might run out of steam. On the flip side, a reading down below 30 or 20 is considered oversold, which could be a sign that the selling is overdone and the price might be ready to bounce back. Okay, we've looked at some seriously powerful tools, but this brings us to what is, without a doubt, the single most important lesson you need to learn about any of this, and that is, there is no magic bullet. You have to remember, no single indicator is perfect, ever. In fact, a lot of the time, they'll give you completely conflicting signals. One might be flashing a giant buy sign while another is screaming sell. The real skill here isn't just knowing one tool inside and out. It's learning how to combine several of them to get a clearer signal. Smart traders often wait until 2 or 3 different indicators are all telling them the same story. So with all that in mind, how do you go from knowing about these individual tools to actually building a real, coherent strategy? Well, let's start by getting one thing straight, and this quote really says it all. People have spent their entire lives looking for that one perfect system that never loses, but it just doesn't exist. The market is way too dynamic for that. So what's the real secret then? It's not about finding some hidden formula. True success comes from the grind, from learning, from experience, and from seeing for yourself how these tools react in different situations. It's about combining them in a way that makes sense to you and building a system that fits your own personal style. The journey from guessing to analyzing starts with learning your first tool. You've seen a few of the big ones today, so the only question left for you is, which one are you going to master first? All right, what if I told you that the very same pattern that shapes a seashell or the spiral of a galaxy could actually predict the next big move in the stock market? Yeah, I know, it sounds a little out there, but that's the whole idea behind Fibonacci trading. So today, we're going to unravel this fascinating concept and see how traders use it literally every single day. You know, it sounds like a riddle, right? But the answer is a kind of hidden mathematical code. A code that, believe it or not, some of the most successful traders in the world use to get an edge. Okay, so to crack this code, we've got to take a quick detour. We're stepping off the trading floor for just a minute and heading right into the heart of nature itself, because that's where this secret sequence shows up in the most beautiful and frankly unexpected places. And this is what we're talking about, Fibonacci sequence. It's really just a simple, elegant pattern that starts with 2 numbers.
But from that super humble beginning, it builds this incredible sequence that just goes on forever. I mean, look at it. It's just simple addition, but this right here is the key to a universal pattern. Seriously, from the number of petals on a flower to the perfect spiral of a galaxy, this sequence is everywhere. It's like nature's blueprint. And as we're about to see, it's also a surprisingly powerful tool for traders. But here's where the real magic happens. If you start playing with these numbers, like if you divide any number in the sequence by the one that comes right after it, you always get a very, very special ratio, about 0.618. This is the golden ratio, and it is the absolute key to unlocking how Fibonacci trading works. This number right here, this is the golden ratio. It's a number that has totally fascinated artists and mathematicians for centuries. And it's also a number that traders believe can help predict what the market's going to do next. So the big question is, how do we turn this ancient number into a modern, winning trading strategy? Okay, so we're back on the trading floor. We're going to take these, magical numbers we found in nature and turn them into a powerful, practical trading tool. It's time to turn all this theory into something we can actually use. And here's the best part. You do not need to be a math genius to use this stuff. Not at all. You just need to know that you're not alone. Millions of other traders are watching these exact same levels, and that collective attention, well, that's exactly what makes them so powerful. So these are the key percentages you'll actually see on a trading chart. They're all derived from that golden ratio we talked about, and traders use them to guess where the price might go next. We're going to focus on the two main tools that use them, retracement and extension. Think of it like this. Retracement, that's your treasure map. It helps you find those hidden entry points where a price pullback might finally stop. Extension, on the other hand, well, that's your compass. It points you toward where you should probably set your profit targets to cash out. So let's start with retracement. This tool is all about finding those sweet spots where the market kind of takes a breath before it continues on its journey. It's your chance to hop on board a moving train, so to speak. And here's what it looks like in action. The tool just draws these horizontal lines on your chart, and boom, it creates a roadmap of potential support and resistance levels. It's almost like having a crystal ball that shows you exactly where the price might bounce. And honestly, it's so easy to use. First, you just find a clear price move, what traders call a swing. Then, you just click and drag the tool from the start of that move to the end. The software does all the heavy lifting. All you have to do is watch for the magic to happen at those levels. The strategy is really simple. You buy at support and you sell at resistance. It's a classic trading mantra, right? But with Fibonacci, you've got this powerful tool that helps you pinpoint these key levels with way more precision. So you're in the trade, the market's moving in your favor, but now comes the million-dollar question. When do you take your profits? Well, that's where our next tool, Fibonacci Extension, comes to the rescue. The extension tool is kind of like a time machine. It takes those same Fibonacci ratios and it projects them out into the future, giving you a sneak peek at where the price might be heading next. It's like your secret weapon for setting ambitious but still logical profit targets. So let's say you've caught the bounce and the price is just soaring. The extension levels give you a clear, data-driven roadmap of where you might want to cash out and take your profits before that rally runs out of steam. It's really the key to maximizing your gains. All right, so we've seen the magic, we've seen the tools, but now it is time to address the elephant in the room. I mean, really, how can a bunch of numbers from a seashell possibly predict what millions of traders are going to do? Let's get into what's really going on here. It really does feel like magic sometimes, but it's not. The answer isn't written in the stars, it's written in our own minds. It's a huge psychological game, and Fibonacci is one of the keys to playing it well. And this, right here, is the secret. It's not about some cosmic destiny, it's about crowd psychology. You have millions of traders looking at the exact same charts, plotting the exact same levels, and putting their buy or sell orders right there. This creates this incredibly powerful feedback loop, a self-fulfilling prophecy, and you can be a part of it. And just remember, you don't have to be a math whiz to do any of this. Your trading platform does all the work for you. With just a few clicks, you can unlock the power of Fibonacci and start seeing the market in a completely new light. So what do you think? Is Fibonacci a map to the market's hidden secrets, or is it a tool that's so popular it actually shapes the market itself? The answer is probably a little bit of both, but one thing is for sure, it's a powerful tool that can give you a serious edge. So the next time you see those lines on a chart, you'll know the secret of the golden ratio. Thanks for tuning in.
All right, let's dive right in. Today, we're going to talk about something that's really at the heart of technical trading, the trading cycle. Think of it as this hidden rhythm that a lot of traders believe is driving pretty much every move the market makes. We're about to map it all out.
You know, it's the million-dollar question, isn't it? Are the markets just a bunch of random, chaotic noise? Or is there some kind of predictable pattern hiding underneath it all? For literally centuries, this is what traders have been trying to figure out.
And that search is exactly what led to the entire field of technical analysis. It's all built on this one single idea, that history tends to repeat itself, that you could actually see patterns emerge in how prices move, and if you can understand those patterns, you just might get an edge.
Now, of all the different patterns and complicated theories out there, there's one that's kind of the granddaddy of them all. It's the foundation for so much else. It's called the trading cycle, and that's exactly what we're going to break down right now.
And there it is. I know, at first glance, it just looks like a smooth hill, right? But don't let the simplicity fool you. This shape is an incredibly powerful roadmap for the typical life of any price trend, from the moment it's born to its peak and all the way back down again.
So let's get a little more specific. What is the trading cycle? Well, it's a model. It's a simplified picture that shows you how a price trend gets started, how it grows up, how it eventually runs out of steam, and then how it sets the stage for the whole thing to start over.
So why is this so important? I mean, why should you care? Because this model gives you what the source material calls useful signposts. It's like having a map on a long road trip. It helps you figure out where you are in the journey of a price move, which is absolutely critical if you're trying to make smart decisions.
Okay, so this whole journey can be broken down into 5 distinct phases. We're going to walk through every single one, starting from the very bottom, going all the way up, over the peak, and back down the other side. Let's kick things off with phase 1.
Every big move has to start somewhere, and this is it, the early phase. Think of this as the very bottom of the hill. The price might have been going nowhere, or even falling, but now you start to see these little signs of life. The momentum is just beginning to build, kind of quietly gathering steam for the big climb.
And then bam! We hit the growth phase. This is the part that gets everybody's attention. That early momentum just explodes and the price starts shooting up. This is where the trend gets strong, it gets obvious, and it's where a lot of the big gains are often made.
But, you know, no tree grows to the sky. No trend lasts forever. We eventually get to phase 3, price consolidation. The climb starts to lose its energy, the momentum fades, and the price just kind of flattens out at the top. This is the peak of our hill, and it's a time of real uncertainty, where buyers and sellers are basically in a tug of war.
And after that battle at the top, what usually comes next is the trip back down. This is the price decline phase. The trend has clearly flipped, and prices start to fall, a lot of times just as fast as they went up. All that momentum is now pointed straight down.
Finally, we land in the valley. This is the repeat phase. The fall slows down, the price finds a bottom, and the market kind of catches its breath, and this part is key. This period of calm becomes the launch pad for the next early phase. The cycle is complete, and it's ready to do the whole dance all over again.
Okay, so we've got this really clean, really perfect model. It looks great on a slide, right? But anybody who's actually looked at a real-time price chart knows that reality is, well, it's a whole lot messier than this.
And this is probably the most crucial lesson of all. The source material is super clear on this. In the real world, these cycles almost never look this perfect. They get stretched out, they get squished, they have false starts, they're just noisy.
So that brings up a really fair question, right? If the real market is this messy, then what is the point of looking at this perfect little model? Why does it even matter?
And here's why it matters. It's not a crystal ball. It's a mental model. It gives you a framework to think with. It helps you guide your overall strategy. It gives you those signposts we talked about for spotting potential entry and exit points. And it even makes other trading tools more useful because you have a better context for what the market's doing.
And this is really how these ideas build on each other. Once you really get this simple cycle, you've taken the first step toward understanding much more complex theories, like Elliott wave or harmonic patterns. Because really, those are just more detailed, more intricate versions of this exact same core idea.
So the next time you pull up a price chart, don't look for this perfect, smooth curve. It's not going to be there. Instead, try to look for the story. Can you see the hints of an early climb, the strong growth?
the topping out, the decline, and then the valley? Because now that you know the pattern, you might just start seeing its echo everywhere.
Welcome to The Explainer. Today, we are diving deep into the financial markets, and we're going to try to decode the complex world of advanced chart patterns. Is there really a hidden language in the charts that can give us an edge? Let's find out.
You know, when you first look at a price chart, it can seem totally chaotic, right? Just a mess of jagged lines bouncing all over the place. A lot of people think that's all there is to it, just random, unpredictable noise. But what if there's an actual order to it all?
Well, the core idea we're digging into today completely challenges that notion of pure chaos. It suggests that markets don't really move randomly at all. Instead, they move in repeating patterns and cycles that are driven by something, well, very human.
And that brings us to our first big idea. The market has a memory. Its ups and downs aren't just random events. They're actually the result of the collective hopes, fears, and emotions of millions of traders. In other words, it's all about human psychology. Now, this isn't some new idea. Way back in the 1920s, a guy named Ralph Nelson Elliott was looking at years of stock market data and had this huge breakthrough. He figured out that the collective mood of investors, this mass psychology, actually creates predictable repeating patterns that he famously named waves. All right, so let's really get into this discovery, which has since become one of the most famous methods in all of technical analysis, the Elliott wave theory. So Elliott basically broke down market movement into two simple types of waves. You've got impulsive waves, which are the big moves that push the price in the direction of the main trend, and then you have corrective waves, which are the smaller pullbacks that go against that trend. And through all his research, he noticed something incredibly specific. He found that a primary trend, one of those big impulsive moves, almost always unfolds in a structure of 5 distinct waves. And right after that 5-wave push is all done, it's followed by a correction, which is typically made up of 3 waves moving back against that main trend. Put those two pieces together, and this is what you get, the classic 5-3 pattern. 5 waves moving with the trend and 3 waves pulling back against it. This whole sequence represents one full cycle of market psychology, from optimism to pessimism and all the way back again. Now, here's where it gets really mind-bending. The most powerful part of this theory is the idea of fractals. Elliott realized this 5-3 structure is fractal. That means the same pattern you see on a daily chart, well, it also shows up on an hourly chart and even on a 1-minute chart. It's like a Russian nesting doll of market movements, a pattern within a pattern within a pattern, repeating over and over again. Okay, so let's build on that idea of structure and pivot to another family of patterns. These add a whole new layer of geometric precision to the charts. They're known as harmonic patterns. Now, unlike Elliott waves, which are all about counting waves, harmonic patterns are about measurement. They use specific ratios that come from the Fibonacci sequence, which is this wild mathematical pattern you find literally everywhere in nature, from seashells to galaxies, to try and pinpoint exactly where the market might turn around. The simplest one to start with is the ABCD pattern. It's pretty straightforward. It's made up of 3 distinct price moves that form a kind of zigzag shape. You get an initial move, called the AB leg, then a little correction, the BC leg, and then one final push, which is the CD leg. And here's the cool part. It's the mathematical relationship between these legs that's so important. The length of that BC correction and the final CD leg are expected to hit very specific Fibonacci ratios. So when all those numbers line up and the price hits point D, traders start watching for a potential reversal. But you know, the ABCD pattern, that's really just the tip of the iceberg. From that basic shape, a whole family of more complex, multi-point geometric patterns emerges, and each one has its own super specific set of rules and ratios. For example, you've got patterns like the Gartley and the bat. And as you can see, they kind of look like stretched out M or W shapes on the chart. They might look similar, but the exact Fibonacci measurements for each point are different, and that's what gives each pattern its own unique signature. And then there's another popular one, the butterfly pattern. Again, notice how it shares that same geometric multi-point structure? The whole goal for a trader is to spot these formations while they're still developing, so they can anticipate where the pattern is likely to finish and potentially reverse course. Okay, so we've seen all these waves and these kind of weird geometric shapes. What's the practical takeaway here? I mean, how do you actually use this stuff? Look, the absolute #1 lesson is patience. Seriously, one of the biggest mistakes people make is jumping the gun before a pattern has fully formed. You have to wait for confirmation. But just like anything, the more you look for these structures on all the different time frames, the easier they become to spot. It just takes experience. And you've got to remember, these patterns are not a crystal ball. No pattern works 100% of the time. It's better to think of them as a language that tells you about the market's psychology. They give you clues about what's more likely to happen next, not what's guaranteed.
Learning to see these shapes can totally change how you look at a chart. What once looked like just a bunch of random noise can start to look like a readable map of market sentiment, a visual story of supply and demand. So the question is, now that you've been introduced to the language, what story are the charts going to tell you? So if you're trading Forex, you definitely know that feeling, right? Staring at a chart, trying to guess what it's going to do next. But what if I told you that the chart you're looking at might be hiding the most important parts of the story? That's exactly where timeframes come in. And understanding them is absolutely key to seeing the whole market landscape, not just that one little tree right in front of you. You see a chart like this, looks like a pretty clear uptrend. And your first thought is probably, okay, time to buy. But wait a second, are you sure you're seeing the whole picture? Because what if this nice, simple-looking chart is actually leading you right into a trap? So here's what we're going to walk through. First, why a single chart can totally lie to you. Then we'll talk about your trading camera lens, what time frames really are. After that, we'll figure out how to choose a style that fits you. Then comes the pro stuff, using multiple time frames. And finally, we'll talk about how you can find the system that just clicks for you. All right, let's dive right into the biggest mistake so many traders make, and that's just laser focusing on one single chart. This tunnel vision, well, it can paint a totally false picture of what the market is really up to. Here's the fundamental problem. When you rely on just one time frame, you're only getting a tiny snapshot in time, not the full movie. And let's be honest, making trades based on incomplete information is pretty much a recipe for disaster. Let's play this out with a classic example. So imagine a trader who only looks at the 5-minute chart. They see the price ticking up, it's making higher highs, higher lows. Everything is just screaming buy. To them, this looks like a sure thing. But, and this is a huge but, another trader is looking at the exact same currency pair, but they've zoomed out to the 1-hour chart. And what do they see? The complete opposite. That little 5-minute rally? Turns out it's just a tiny little blip in a massive, powerful downtrend. So who do you think is really on the right side of this trade? Okay, so how do we keep from falling into that trap? Well, it all starts with understanding our tools. So I want you to stop thinking about these as just charts and start thinking of them as different lenses for your camera. Really, at its core, a time frame is just the window of time you're using to look at the market. Every candle, every bar on your chart represents a set amount of time. It could be 1 minute, or it could be a whole day. And this camera analogy is perfect. Think about it. A long time frame, like a daily chart, that's your wide-angle lens. It gives you the big, sweeping view, the entire mountain range. But a short time frame, like a 1-minute chart, that's your zoom lens. It lets you get right up close and personal with a single tree, seeing every little twitch and fluctuation in the market. And the great news is, as a trader, you have a whole camera bag full of these lenses to choose from. You can go from the super detailed 1-minute chart all the way up to the big picture 4-hour or even daily charts. And each and every one gives you a totally different perspective on the exact same market. So naturally, that brings us to the next big question. With all these lenses to choose from, which one's the right one for you? And look, there's no single magic answer, but we can definitely find the right fit. This is so important to get. The time frame you choose is deeply personal. It's got to match your personality, your goals. Are you someone who loves that adrenaline rush of quick in and out trades? Or are you more of a set and forget it kind of person who wants to play the long game? Let's just break down the trade-offs here. Shorter time frames? We're talking fast, frenetic action. It can be super high stress, but you often need less capital to get started. Now on the flip side, longer time frames are way slower, much less stressful, but you'll probably need more capital to ride out those bigger market swings. It's really that classic choice. Are you a day trader or a long-term investor? So if you're just starting out, where do you even begin?
Honestly, a great middle ground is often a medium-term time frame, something like the 1-hour chart. It kind of filters out all that chaotic noise from the really short time frames, and it gives you more time to think and analyze without feeling totally swamped.
Okay, so you've thought about your style. You've picked a lens you like. But now we get to the real secret sauce. This is the technique that truly separates the amateurs from the professionals.
And here it is. This is the key. Professionals never, ever rely on just one time frame. They know that to get the real, unbiased story of the market, you have to look at it from different angles. You've got to combine that wide-angle, big-picture view with that zoomed-in, detailed shot.
So how do you actually do this? It's a pretty simple 4-step process. First, pick your main chart. This is where you'll do most of your thinking. Let's say, for example, it's the 10-minute chart. Step 2, add one time frame that's shorter, like the 1 minute. This helps you nail your entries and exits. Step 3, and this is so important, add 2 longer time frames, like the 1 hour and the 4 hour. This tells you what the main trend is. Then for step 4, you look for agreement across all of them. That's where the magic happens. See, this whole process is about building a complete 3D picture of the market. When that short-term signal you see on your 1-minute chart lines up perfectly with the major trend you're seeing on your 4-hour chart, that is your confirmation. That's the green light. And this alignment gives you so much more confidence because you're not just guessing anymore. You're seeing the market in its entirety. Wow, okay, we've covered a lot of ground, from the dangers of that single view all the way to the pros multi-lens approach. But it really all boils down to one final critical point. And if you take away just one thing today, let it be this. You can read all you want, but absolutely nothing beats hands-on practice. Get on a demo account, play around with different combinations of time frames, and just find what clicks for you. Find the setup that makes the market story clear and easy to understand for you. So I'll just leave you with this question. The very next time you open up a trading chart, just stop for a second and ask yourself, am I just looking at a single page here? Or am I actually reading the whole book? What story are your charts really telling you? All right, let's talk about one of the most exciting and frankly nerve-wracking moments in trading, the breakout. Today, we're going to pull back the curtain on these powerful price moves so you can learn how to spot them, how to trade them, and most importantly, how to avoid the traps that catch so many people out. Okay, let's jump in. I mean, this is the million-dollar question, isn't it? You see a currency pair just take off like a rocket or fall off a cliff, and you're just kicking yourself thinking, man, how could I have gotten in on that at the start? Well, that's exactly what we're going to unpack today, the actual strategy behind catching those huge, fast-moving trends. So, first things first, to catch these moves, you've got to know what you're looking for. In the trading world, we have a name for these powerful shifts. They're simply called breakouts. So, what does that really mean? Well, think of support and resistance as price floors and ceilings. A breakout is when the price doesn't just tap on that ceiling, it smashes right through it and just keeps on going. It's the market making a really decisive move, and that often creates a rush of activity that pushes the price even further. And look, these breakouts aren't all the same. Sometimes a breakout just continues a trend that was already happening. Other times, it signals a complete U-turn into a brand new trend. And sometimes, it just breaks out of a really boring, sideways market. It's this versatility that makes them such a critical tool in any trader's playbook. Okay, so what's the fuel for this fire? What powers these massive moves? In the stock market, you look at trading volume. But in Forex, getting a true sense of volume is tricky, right? So volatility becomes our best guide. High volatility is a pretty good sign that a lot of people are in the market, providing plenty of juice to keep a big move going. So that brings us to the how. How do we actually trade this? If high volatility is the fuel, you think, okay, I gotta jump in when things are going crazy, right? Well, that's what most traders do. And it's a huge, huge mistake. This is classic FOMO trading, fear of missing out. You see the move happening and you chase it, trying to jump onto a rocket that's already halfway to the moon. But the danger is that same volatility that created the opportunity can cause a violent snapback that can wipe out your trade in the blink of an eye.
And this is where the pros flip the script entirely. It's completely counterintuitive. Instead of chasing the storm, the professional trader is looking for the calm before the storm. You're actually searching for markets that are quiet and boring.
Now, why on earth would you do that? It's simple, really.
Low volatility gives you the single most valuable thing in trading, time. It gives you time to analyze, time to plan your entry and your exit, and time to set the trade up on your terms. You get to be there right at the beginning of the wave, instead of trying to jump on in the middle. Of course, not every quiet market is about to explode into a breakout. Sometimes you get a false signal, a fake out, that's designed to trap traders. So the big question is, how do we tell the difference between a real move and a fake out? Well, you need a toolkit. And here it is. A simple but really powerful 3-step check. Before you even think about entering a trade, you run it through these 3 filters, each using a specific technical tool to get a much clearer picture of what the market is actually doing beneath the surface. Step 1, we confirm that we have low volatility. Bollinger Bands are perfect for this. I want you to think of them like a rubber band wrapped around the price. When those bands get squeezed super tight, that's a visual sign the market is coiling up like a spring. When they start to widen, that spring is being released and your breakout might be starting. Next up, we need to gauge momentum. In other words, is there any real oomph behind this move? For that, we turn to the MACD indicator. If a new trend is taking shape, you want to see that MACD histogram getting bigger and taller. That tells you there's real conviction behind the move. And finally, we check for exhaustion. Has this move gone too far, too fast? The RSI helps us figure that out. It tells us if a market is getting overbought or oversold. Basically, if it's running out of steam and might be due for a reversal. This can be a huge warning sign that your breakout is about to fail. And that brings us to the biggest threat of all. The fake out. This is the trap. It's when the price breaks through a key level, everyone jumps in, and then it violently snaps back in the other direction. And often this isn't random. Big institutional players know how retail traders think, and they can use that predictability against them. Okay, let's kick it up a notch and talk about a more advanced skill. Sometimes the price on your chart is telling you one story, but the momentum behind it is telling you a completely different one. This is called divergence, and learning to spot it is like learning to read the market's hidden signals. The core idea here is actually really simple. Price and momentum should, hold hands and move together. When they let go and start walking in opposite directions, that's a massive clue that something's changing under the hood. The trend might be losing its strength. And you've basically got 2 main flavors to look out for. You've got regular divergence, which is a warning sign, a heads up that a trend might be about to make a U-turn, and then you have hidden divergence, which, funny enough, actually gives you confidence that an existing trend is still strong and ready to keep going. So with regular divergence, you're looking for a conflict. For example, the price is huffing and puffing its way to a new high, but your indicator just can't keep up. It makes a lower high. That's a classic warning sign. It's like the engine driving that trend is running out of gas. Hidden divergence is a bit sneakier, but it's a fantastic confirmation signal. So picture an uptrend that takes a little breather. The price pulls back, but it makes a higher low, which is good. But the indicator dips down to a lower low. This actually suggests that pullback was just a pause, and the original trend has plenty of strength left to continue. Look, we've talked about a ton of tools and indicators, but the real strategic edge, the thing that separates the pros from everyone else, it isn't on your chart. It's between your ears. It's all about discipline. And this is so important to remember. None of these tools are a magic crystal ball. Bollinger Bands, MACD, divergence, they are all just pieces of a puzzle. Their real power comes when you use them together to confirm what you're seeing in the market. They are supporting actors, not the main star. I'm going to leave you with what I think is the single most important piece of wisdom from all this, and it's this quote right here. Seriously, let that sink in. Sometimes the absolute best trade you can make is no trade at all. If you're not sure, just wait. Missing an opportunity is always better than forcing a bad trade and taking a loss. So the next time you're looking at the charts, I want you to ask yourself this question. Are you just reacting to the moves on the board like a pawn, or are you thinking ahead, anticipating the strategy, and positioning yourself to be the one moving the pieces? That, right there, is the difference between chasing the market and trading like a pro. Welcome to The Explainer. Today, we're going to demystify a financial strategy that sounds almost too good to be true, the carry trade. It's all about making money from things just sitting still. So let's kick things off with a bit of a puzzle. How on earth can you make a profit in a financial market that's just standing completely still? I mean, it sounds impossible, right? But believe it or not, there's a really powerful trading strategy designed to do exactly that. And the answer to that puzzle, it's something called the carry trade. At its heart, it's a strategy that isn't about chasing wild price swings. Nope, it's all about exploiting differences. The basic idea is actually pretty simple. You borrow something, in this case a currency, that has a super low cost, like a low interest rate. Then you turn around and use that borrowed money to buy another currency that pays you a much higher interest rate. And your profit? Well, you just pocket the difference. Okay, let me give you a simple analogy to make this crystal clear. Imagine you could walk into a bank and get a loan for, say, 2% interest. Then you take that exact same money and you pop it into a savings account that pays you 6% interest. You see where this is going? The magic here isn't that the money itself is growing. Your profit comes purely from that 4% difference, that gap between what you have to pay on the loan and what you earn from your savings. It's a pure arbitrage on interest rates. Now, of course, your local bank isn't just going to let you do this. But in the massive world of foreign exchange, the Forex market, this exact strategy is not only possible, it's super common, and it can be a really powerful tool for traders. So what makes it so powerful in Forex? Well, there's a magic ingredient, and it's called leverage. Leverage basically lets you use a small amount of your own money to control a much, much larger position in the market. It's like a financial magnifying glass. It amplifies your potential gains, but, and this is a big but, it also amplifies your potential losses. All right, let's walk through a real-world example so you can see this in action. Let's say you open up a trading account and you put in $10,000. Okay, now your broker comes along and offers you 100-to-1 leverage. So what does that mean? It means for every single dollar of your own cash you put on the line, you get to control $100 worth of currency. So get this, by using just $1,000 from your account as collateral, or what they call margin, you now have control over a full $100,000 position in the currency market. Pretty wild, huh? Now, let's bring it all together. If you find a currency pair that has that same 4% interest rate difference we talked about, you're now earning that 4% not on your little $1,000 margin, but on the entire $100,000 position. Do the math. Over a year, that's a cool $4,000 in profit. And remember, that's even if the price of the currencies doesn't move a single tick. And here's the real kicker. That $4,000 profit, that's on your initial $10,000 account, which means you just made a 40% return on your investment. A 40% return. That is the incredible power of leverage in action. Okay, but let's get real for a second. In the actual market, currencies almost never just stand perfectly still. They wiggle, they jiggle, they go up and down, and that volatility, it introduces risk. This means there are really 3 different ways a carry trade can play out. So let's break down those 3 scenarios. First, what if the price of the currency you bought falls? Well, your capital loss from that price drop could easily wipe out or even be bigger than your interest gain. Not good. Second, if the price stays flat, you're golden. That's our ideal scenario, where you just collect that pure interest gain. But then there's the third outcome, the home run. If the price of your currency rises, you hit the jackpot. You get the interest gain plus a capital gain from the price moving in your favor. And that, of course, brings us to probably the most important part of this whole thing. You have to understand and manage the risks. This isn't free money. The carry trade has a flip side, and you've got to respect it. You know, the most basic risk is just getting the trade backward. If you accidentally buy the currency with the low interest rate and sell the one with the high rate, you've just created what's called a negative carry. And in that situation, instead of getting paid the difference, you're the one who has to pay it every single day. That's a surefire way to bleed your account dry. So how do the pros handle all this? Well, they don't just guess. They follow a very disciplined process. Step 1, they do their homework, researching central bank interest rates to find a pair with a nice chunky difference. Step 2, and this is super important, they look at the charts. They use technical analysis to make sure the currency is already in an uptrend, to get the wind at their backs. And finally, they play defense. They always set stop losses to automatically get them out if the trade goes wrong, and they limit how much of their account they're willing to risk on any single trade. Okay, so for the final piece of the puzzle, let's zoom out and look at the big picture. What kind of economic weather is perfect for the carry trade to really shine? Basically, the carry trade loves it when everyone's feeling good. It thrives in times of optimism and stability.
It works best when investor confidence is high, when the economy is strong enough that central banks are actually raising interest rates, and when the market isn't going haywire. You could say it's really a bet that the good times are going to keep on rolling.
And that right there, that reveals the carry trade's Achilles heel. Because when fear and panic hit the markets, the exact opposite happens. Investors get scared and they pull their money out of those riskier high-interest currencies and they run for cover in so-called safe haven currencies. Think the US dollar or the Swiss franc, even though those pay way less interest. This sudden rush for the exits can cause the high-yield currency to just tank, potentially wiping out months or even years of slow and steady interest gains in a matter of days. So that leaves us with a final thought-provoking question, doesn't it? At its very core, the carry trade is a bet on economic stability. But in a world that feels more volatile and unpredictable than ever, you really have to ask yourself, is that a wise bet to make?
All right, so you've been hitting the books on Forex, right? But there's this huge gap between knowing the theory and actually making a trade. Well, today we're going to build that bridge. We're taking all that theory and turning it into a real, actionable plan.
So, you've put in the work. You know your pips from your lots. You can probably spot a trend line from a mile away. But now what? What's the actual next step? How do you take all that brain power and actually step into the live market without getting burned? That's exactly what we're going to get into.
All right, first things first. Before you even think about putting a single dollar on the line, we've got to lay some groundwork. This part is all about getting your head in the game and being prepared. Okay, so what's the absolute #1 thing you should do before you trade? Practice. Seriously, just about every broker out there offers a demo account, and you've got to use it. Think of it as your personal sandbox, a totally risk-free playground where you can learn the software, test out your ideas, and just get comfortable with the mechanics before any real money is involved. So once you're feeling good with the software, the next step is, well, it's about figuring out who you are as a trader. There's really no one-size-fits-all strategy here. The best approach is always going to be the one that actually fits your personality, your lifestyle, and how much time you can really spend on this.
So let's just ask it straight up. Which trading style actually fits your life? I mean, are you someone who can be glued to the screen all day, or do you have a 9 to 5 and can only check in on things in the evening? The answer to that question is going to point you in the right direction.
And this pretty much breaks it down into 4 main types. First, you've got the scalp trader. These guys are in and out of trades in minutes, making a ton of tiny profits. It's intense, it's an all-day thing. Then there's the day trader, who makes a few trades but makes sure they're all closed out by the end of the day. A bit less frantic. Now the swing trader, this is a really popular one. You might hold a position for a few days, which is perfect if you have a day job, because you can do your homework at night. And finally, the position trader. They're the long-haul folks, thinking in weeks, months, even years. This takes a lot of patience and a really solid grasp of the big picture.
Okay, so you've figured out your style. What now? Well, now you need a blueprint, a personal trading plan. This is basically your rule book, the set of guidelines you create that will dictate every single move you make.
And this quote just nails why that plan is so critical. Look, when you're trading, emotions like greed and fear can totally take over. Your plan is what keeps you grounded in logic. It makes sure you're reacting based on your strategy, not just some gut feeling when the market gets crazy.
So what actually goes in this plan? Well, it all starts with defining your profile, that trading style we just talked about. Then you set some really clear goals. And this is huge. You have to determine how much risk you're willing to take. After that, you plan your routine. And finally, you need a way to track everything, to record your progress and see how you're doing.
And look, this plan, it's not some document you write up, file away, and never look at again. Nope. It's a living, breathing thing, and it's supported by your daily rituals and the tools you use to stay on course. And the 2 most important tools in your toolkit are going to be your trading diary and your trading journal. It's a really simple but powerful difference. The diary, that's your roadmap for the future. The journal, that's your review of the past. So in your diary, you're always looking forward. You're jotting down potential trades you see coming up. You're defining your exact entry points, your profit targets, how big your position will be, all your rules for managing the trade. This is all the prep work you do before you even click the button. The journal, though, that's for after the fact. Once a trade is closed, you go here to break it down. What was the idea that sparked it? What did you see the market do? Did you stick to your rules for getting in and out? And then you do a final evaluation.
This is where the real learning happens, from both your wins and your losses. It's how you get better. Okay, so we've covered a lot, right? Practice, figuring out your trading style, making a plan, using the right tools. But there's one last thing, one element that holds all of it together. And honestly, without it, the whole thing just falls apart. It's the golden rule.
You could literally have the best trading strategy ever invented, the most detailed plan, the most perfect journal. But none of it, and I mean none of it, matters without this one thing. And that thing is discipline. It's as simple and as hard as that. Discipline is just the act of actually doing what your plan says you're going to do, especially when it's tough. It's hitting that stop loss when you're supposed to, even when every part of you is hoping the market will magically turn around. It's just sticking to your rules trade after trade, day in and day out.
And the source material we're looking at is crystal clear about this. Trading discipline isn't some super complicated psychological concept. It really just means you decide on a plan and you stick to it, period. And that brings us right to the end. You have the blueprint now. You know the steps. Practice, find your style, build a plan, use your tools. So the only question that's left is the one that only you can answer. Are you disciplined enough to follow it?
Welcome to The Explainer. Today, we're going to pull back the curtain on what really separates professional traders from everybody else. And spoiler alert, it's not about having a crystal ball. It's about having a blueprint. So we're going to build that blueprint together, piece by piece, and see exactly how the pros create order in the wild chaos of the financial markets.
All right, let's jump right in with the first and maybe most important question that every single trader has to ask themselves. This really gets to the core of everything.
You've got to be honest with yourself on this one. And the answer, the one thing that separates a calculated professional approach from just throwing a bet on the table, is having a system, a plan. That's it. That's the entire game.
So let's be super clear here. A trading system is not some secret magic formula. It's a disciplined framework. It's your personal rulebook for spotting trends, knowing exactly when to get in and when to get out, and actively managing your trade. It's how you take the messy, unpredictable market and give it structure.
Okay, so how do you actually build this blueprint for yourself? Well, it really comes down to 6 core steps that are the foundation of basically any professional trading strategy out there.
Let's walk through them. First up, you have to pick your time frame. Are you a day trader, in and out in hours, or are you holding for weeks or months? That one decision changes everything. Next, you need indicators. Think of them as your dashboard gauges. You'll need some to spot a potential trend, and then others to confirm that, yeah, this is the real deal. Then comes the absolute cornerstone, risk management, which we are definitely going to spend more time on. After that, you need crystal clear rules for your entry and exit points, no winging it. And finally, the step that trips everyone up. You have to write it all down and then actually follow your own rules, no matter how much your stomach is churning. And this right here is exactly why that last step is so critical. The sources are really clear on this. The single biggest mistake new traders make is creating a great system and then letting fear or greed talk them out of it. Seriously, even the world's best blueprint is totally useless if you just throw it out the window when things get emotional.
Now, let's zoom in on the one part of the blueprint that professionals will tell you is completely non-negotiable. This is what keeps you in the game long enough to succeed, building your financial foundation through solid risk management.
This is the golden rule, the first commandment. Why? Well, think about it. If you're trading with money you need for rent, it's pretty much impossible to stay calm and make rational decisions. That emotional pressure is what forces you to break your own rules and sabotage your whole system.
And to really hammer home why this is a rule for survival, not just a suggestion, let's look at a tale of 2 traders. This story shows the raw, undeniable power of managing your capital correctly.
So here's the setup. We've got trader A, who's very disciplined, risking just 2% of their money on any one trade. And then we have trader B, who's a bit more aggressive, risking 10%. They both start with 20 grand, and they both hit a rough patch, a completely possible losing streak of 10 trades in a row.
And here is where it gets incredibly real. You can see the brutal math right here, trade by trade. On the left, that's the slow, manageable decline of the 2% trader. But on the right, look at that. It's not a slope, it's a cliff. The difference in their paths is just staggering.
So after those 10 losses, trader A, our 2% risk taker, is down about $3,300. Yeah, that stings, for sure. But most of their capital is still there. This is a hole you can climb out of. They get to keep playing the game.
But now, look at trader B.
By risking 10% each time, they've lost over $12,000. That's more than 60% of their starting money just gone. This isn't a setback, it's a catastrophe. Coming back from that is almost impossible. They've basically been knocked out of the game entirely.
So the case for strict risk management is pretty clear, right? But how do you actually enforce that discipline in the heat of the moment? Well, let's look at the practical tools the pros use on every single trade.
Okay, your number one tool for discipline is the stop loss. Think of it as your automatic safety net. It's an order that gets you out of a trade at a specific price you decided on before you were emotional, and it limits your loss. Now the trick is placing it right. Too close, and a normal little market bounce might knock you out of a perfectly good trade. Too far away, and you're risking way too much. A pro tip is to use what are called support and resistance levels, kind of like historical price floors and ceilings, to help you find a logical spot.
This leads to a super practical question. Okay, a stop loss tells you where you get out, but how do you know how much to trade in the first place? How do you make sure that exit point perfectly lines up with your 1% or 2% risk limit? This, my friends, is called position sizing.
And it's a simple three-step formula. Let's say you've got a $5,000 account, and your rule is you'll only risk 1% per trade. Step 1 is a piece of cake. What's 1% of $5,000? $50. That's your maximum allowed loss for this one trade.
Okay, for step 2, you have to know where your stop loss is going. Let's say your plan says it should be 200 pips away. A pip is just the tiniest little unit of price change. So you take your maximum risk, that $50, and you divide it by those 200 pips. The answer is 25 cents. That's your target. For this trade, each little pip move can't be worth more than a quarter to you.
And now for the final step. You translate that 25 cents per pip value into your actual trade size. The math here converts it into 2,500 currency units, and this is the magic of it. By doing this quick math before you click the buy or sell button, you have guaranteed that if you're wrong and the trade hits your stop loss, you will lose exactly $50, your 1% limit, and not a penny more. You've controlled the outcome of a loss before it even has a chance to happen.
And this brings us right back to the beginning. The quote says it all, doesn't it? It is extremely easy to throw the plan out the window when emotions start screaming louder than your good judgment. The math is simple, the rules are clear. The biggest risk in trading is usually the person staring back at you in the mirror.
So, there you have it, the professional's blueprint. The steps are there, the math for managing risk is clear, the plan itself isn't the big secret. The real question is the one right here. You have the blueprint, but do you have the discipline to follow it, day after day, especially on the days it's the hardest? Because that, right there, is what separates the pros from everyone else.
You know, every trader, I don't care if you're brand new or you've been doing this for years, you eventually hit the same wall. And it's not about finding some new indicator or secret algorithm. Nope. The real key, the one thing that's going to make or break your success, is all in your head. It's your mindset. And that is exactly what we are going to unpack today.
So when you first start out, almost every single trader's journey begins in the exact same place. It's this quest, right? A hunt for that one thing, that silver bullet that you think is going to finally unlock all the secrets of the market.
Come on, let's be honest. Does this sound a little familiar? That endless hunt for the holy grail of trading? A totally flawless strategy that promises you'll never see a red trade ever again. It's such a powerful and tempting idea. But you know what? It's also the foundation of a huge myth in the trading world.
Okay, so let's just tackle that myth head on. This whole idea that you can find a setup that offers guaranteed profits. It's one of the biggest hurdles you have to overcome. And why is that? Because it literally sets you up for failure before you even place your first trade.
And you see this promise everywhere, don't you? In books, online courses, from all these so-called gurus. They're all selling the dream of a perfect, guaranteed system. But the truth is, well, it's a lot more complicated than that. It's a really seductive idea for sure, but trust me, it's a trap.
This really just boils it all down to two completely different ways of looking at the world. On one side, you've got the myth, this belief in perfect setups and magic strategies. But then, over on the other side, you have reality. Trading is all about skillfully using a set of tools and techniques, not looking for some kind of crystal ball. The entire game is about shifting your brain from that first way of thinking to the second.
But why, though? Why aren't there any guarantees? What is it about the market that makes it so darn unpredictable? Well, the answer isn't in the charts or the numbers, It's actually in the people behind them.
This visual right here, this really gets to the heart of it. See, markets aren't these cold, logical machines. They are a massive, churning storm of human emotion, a living, breathing expression of the collective hope, fear, and greed of millions of people all at once. I mean, how could you possibly bottle all of that up into a simple, predictable equation? You just can't.
Okay, so if we accept that we can't be right 100% of the time, what happens when we're wrong? This is where the real mindset shift starts to happen. It's all about reframing what a loss actually means to us as traders.
This might be the single most important lesson in this entire explainer. Finding yourself on the wrong side of a trade. Yeah, it feels bad, but it isn't necessarily a bad thing. Think about it. It's data. It's a lesson just waiting for you to learn it.
And here's that whole process in action. So you make a call, and oops, turns out it's wrong, you face the outcome, but then, and this is the absolute most critical step, you learn from it. And all of a sudden, that mistake isn't a failure anymore. It's an asset. It's intelligence that makes you smarter for the very next trade. It's this powerful feedback loop for growth.
So if the goal isn't to find a perfect strategy and never, ever lose, then what's the actual goal? What is the real journey of a trader all about?
And this is what it actually looks like. The journey isn't some straight line to a finish called perfection. No way. It's a continuous loop, a constant cycle of analyzing, executing, and then learning. The market is always changing, it's always evolving, and the successful trader is the one who evolves right along with it.
This is what you're really trading for. It's not just profit, it's for new insights. Every single trade, it doesn't matter if it hits your take profit or your stop loss, gives you something valuable. It offers a new idea, a new lesson that makes you just a little bit better of a trader than you were before you clicked that button. So, in the end, it all comes down to this one question. Is your goal to be right on this one single trade? Or is it to be better for all the hundreds of trades to come? Are you just chasing the temporary high of a win? Or are you committed to the long-term journey of becoming a smarter, more resilient trader? The answer to that, well, it's going to define everything.